chase my dollars and make it hurt.
Good day, everyone, and welcome to another episode of Let's Talk Commercial Real Estate Investing, the Black Community Edition. I am your humble host, Dominic Green, Managing Partner of Technical Commercial Real Estate Services here in the DFW area. Welcome, guys, to another episode of Education Wednesdays here on the platform of Let's Talk Commercial Real Estate Investing, where we talk pretty much all things commercial real estate, different sectors, things that we're seeing, sharing information, experience, knowledge, and so forth. So collectively we can come together and invest, acquire, collectively as a group, individually, but hopefully more as a collective, to acquire income-producing commercial real estate for the purposes of funding the things that are most important to us, whether that's family, friends, personal initiative, charities, generational wealth, you name it. Because, here I believe that owning commercial real estate, owning income-producing commercial real estate at that, is one of the requirements, necessities, in helping us to have not only more control, power, leverage, in our own destiny, but at the end of the day, accumulating wealth, having something to pass on to our children, so they don't start in the position that we were born into, for most of us, and then also passing that knowledge on to them, so they can continue the legacy going forward. Because I think, like I said, it's one of the many ways to build wealth, but I think it's one of the proven and oldest and things that, until something dramatically changes in this world, it's still going to be relevant. So today, just wanted to drop in. Normally I would talk about different sectors, but I really wanted to kind of have just a brief conversation about underwriting. So when you're looking at information, looking at trends, finding common themes, looking for opportunity, the next step in that process is kind of like the underwriting process, doing some quick due diligence, figuring out if it's going to make sense to move forward, and either speaking with brokers, lenders, investors, so forth. One of the key things about underwriting, obviously, is going to be the assumptions that you make. You're also going to need some type of software or Excel spreadsheet, which for those who are sophisticated in Google Sheets or Excel, you can create a simple analysis, cash flow analysis document. You can probably find one online and download. I know I've modified ones that I've gotten online for free. You get them from some of your syndicators. If you follow any syndicators, they'll have like a free download that you can modify. But at the end of the day, it's key things that you're looking for. Total amount of income, less expenses, less any CapEx reserves, to get to your net operating income, which is your NOI, to help you value a potential property, regardless of what it is. If it's industrial, if it's multifamily, if it's retail. Now, obviously, there's going to be extra nuances and things that you got to account for, and that you'll be aware of, which we talk about here in the different sectors. When it's part of your underwriting, part of you trying to come up with as I model after sustainable cash flows. So one of the things that I kind of started out with, obviously, is, when I first started, was looking at different videos, figuring out, okay, if I'm modeling the pros, how do the pros underwrite properties? And if you go on YouTube, you'll find some of the guys that were former analysts of the Blackstones, the Black Rocks, and KKR, and they'll kind of give you an insight of how they were underwriting businesses and properties. Is pretty much the same thing, right? And then another source that I can give you guys is Morningstar. So for those who are invested in stock, you know who Morningstar is. They're basically a rating company, especially for like the CMBS market, which is mortgage-backed securities. They actually have an outline of their process of how they underwrite commercial real estate. So what that does is give you a process that you can use over and over again. Use it as a reliable way of evaluating properties. And who other than people that value commercial mortgage-backed securities of properties that are in the hundreds of millions of dollars for investors, right? So if you go to, I think you can actually Google it, CMBS, Morningstar, cash flow valuations, something like that, and you'll see it'll pop up, like you'll see it where it says almost like a PDF file, and then if you go through there, you kind of get some insight. So I kind of taken a combination of all those things, and then I make obviously assumptions because of just the daily stuff that I do every day, being in brokerage, and then I spend a good majority of the time researching and diving in and just trying to get more experience so I can get better at underwriting properties. And because of that, I'll be able to, have a little bit more accuracy. Because you're never going to get something that's perfect. You're just trying to get the best information that you can, make the best assumptions you can, and create estimates that you hope they are conservative enough that you'll be able to hit those targets and convince investors when you're pitching to them that these are what the particular returns are going to be, right? So it just allows you to create a system, and over time, as you do more and more properties, just like what everybody else says, you'll start to tweak that system to your liking. Then you'll start hiring former analysts that went to school to do it, if you want to get more sophisticated. But essentially, those are the basics. Revenue minus expenses, net operating income, and then there's some little small minor details in between, and then whatever the current market cap rate is in the area, which you can get if you call brokers, if you do enough hunting and looking at deals, you'll start to see the trend of what everybody is asking. The brokers will start commenting what their whisper prices are, what their trading things are, and then you'll kind of get an idea of what that particular market cap rates are, and then from there you just capitalize the net operating income, and you come up with a particular value, and then you make your adjustments from there based on any additional assumptions, right? Whether there's something that's a property that's still in lease up, well, then you need to calculate what's it going to cost you to do that, and kind of take that out the valuation, because that's money that you're going to actually spend. You're not going to pay them for that because it's not operating at stabilized value, which you initially calculating. So underwriting is the key. So you got to underwrite not only the property, the quality of the property, the quality of the location. Then obviously if you get any hold of any financials, T12s, current rent rolls, then you start looking at the numbers and plugging them in, and taking other data points that you might have got from other market reports and any sub-market information that you can get. And then you start coming up with a particular value which you were willing to pay for a certain property, and then make sure that it fits into whatever the investor return targets that you are promising investors, or that you believe you need to hit in order to attract investors, right? So one thing you do know, if you've been following me, if you hear me talking, we are in a cap compressed environment, so returns are taking a hit, because there's just so much competition for for certain properties. Let's just put it like that. Mostly multifamily, industrial, and then subsectors of that. So with that, it's pushing down the returns on those properties. And so the same things that, for people who are doing value adds and hitting certain targets, those numbers aren't the same anymore as they were years past, right? It's just not as easy as it was before. Like I said, competition is heavy. So make the adjustments. But with that being said, that also allows for certain type of concepts that may work. And I've mentioned it earlier before when I'm looking at diving into the affordable housing, because, really doing good and still making a profit appeals to me. And then it's a need that's vast. It's a demand that's ongoing. It's probably going to be ongoing for a long time because everybody's still going to need an affordable place to live. The dynamics that are affecting wages are probably still going to continue for a while. The supply is dwindling because, again, you have others coming in and doing value adds and basically just changing the demographics of certain locations. So the natural occurring affordable housing is kind of is decreasing. That supply is decreasing. So, with all that being said, the pitch in my thought process is, hey, because the returns are compressed, that allows, I think, an opportunity for affordable housing, because the model that I'm following and the guys that I'm modeling after, they still are able to get 6 to 8% cash on cash and low double digits. I'm sorry, total returns or IRRs for those that are sophisticated investors on properties that they're holding for anywhere from 5 to 10 years. And for me personally, because of the way that the types of properties I want to acquire in affordable housing, things that have some type of competitive advantage, sustainable power to earn, probably want to hold on those properties for a pretty long time, 10 years, maybe 17 years somewhere. So obviously the investors that I'm looking for are long term, and if there's a way to bring some money out, I definitely will. But I'm looking to hold them pretty long term, cash flow them, refinance them, pull money out, and keep funding it until something changes, or then somebody just comes to us with a big offer and says, hey, we're willing to pay you X, Y, and Z, and it's just, hey, why not? Or maybe we're not able to perform as well as we thought we could, and it's better to just cut our losses and move on to the next one and return the capital while we still can. So, but not to get away from what I was talking about, underwriting is going to be an important key. So once you not only finding the deal, figuring it out, what it's worth, how can you improve the value, sustain the value, get the returns, because you're not doing this alone. For those of you who have the capacity to do it alone, still you want to hit a certain return that's competitive, as opposed to something you actually put your money into to get that same return with the least amount of effort. But again, things that require research, looking for data points, having some type of financial software, one that you can either make or download for free. For those of you who want whatever I have, I can share with you. Just leave a comment in there below, and we'll connect, and I'll get your email and send what I got. I'm always happy to share any resources and data that I have, because business is a team sport. Wealth is a team thing, and it's all about the collective, in my opinion. So if I can be helpful to the collective, we all benefit. Because like I said, the platform is designed to share information, knowledge, experience, so we can all leverage and we can all acquire and we all get better. You know what I mean? So, when you're doing your underwriting, because especially when you're dealing with cap rates, you're dealing with dollar amounts, valuations could be very sensitive to whatever cap rates you use or adjust to. So I think definitely looking at the CMBS Morningstar model probably gives you the best evaluation on how to make changes to cap rates based on underlying conditions. Because like I said, a 1% or 100 basis point jump in the cap rate makes a huge difference in the valuation versus 25 basis points or 0.25 for those who are curious what that is. But because at the end of the day, given the market, you still got to be competitive. You're going to be going against other people. You're more than likely not going to be the only bidder for a property, unless you got it's off market in the sense that you connected with the seller directly and they're not using any representation, and then you may have a chance where you may be the only bidder. In most cases, depending on the type of owner, they typically will reach out to a broker to kind of get an idea as well of what their properties are worth. And if the broker is good enough and has a great reputation, they may end up getting that listing. And so then it goes basically to maybe a select group of bidders. Hopefully you get involved in that. And then you just make your offer and then keep it moving. So you got to also factor that in, the competitiveness of the market, in a sense of what's the most you can pay, in a sense. Underbidding significantly for a huge discount, especially in this market and for certain particular properties, probably won't even get you to the next round. Because typically, from what I'm paying attention to, even the other things that I'm doing, you have your first round of bids. That's where you got all the initial offers, and then you have your second round of bids, where it's basically the round of the mostly highest offers, strong offers. In a certain round, you may get on the phone with the seller, pitch your offer. They want to maybe get some more information about you, where you're getting the money from, what you plan on doing, so forth and so on, who's your lender, all that good stuff. And then depending on how many bids they had in that second round, they'll ask for they'll ask for highest and best then, and then it could go to a third round. And then the third round is really best and final. So there's different approaches to it. There's different ways to make your offer strong when you get to that point. But for me, I always lead with, hey, my best foot forward, and let the chips may fall where they may, and then keep it moving. So even though there's limited supply, for me, it's not about necessary quantity, although there's a certain quantity target I want to hit personally and professionally, but I also want quality because this is something I'm looking to hold for a while, and want to extract value out of it, return it to investors, but keep cash flowing, right? So all those things play into it. So I'll have a longer term horizon, so maybe I can pay a little bit more, as long as the numbers still work, because at the end of the day, the numbers have to work, they have to pencil out. You'll see in people's underwriting when you start, and that's the other good thing I can mention to you. If you aren't already, go ahead and get, depending on whatever sector you're interested in, retail, office, industrial, multifamily, medical, you name it. Locate the brokers, usually the top brokers, and get on their mailing list so you can start receiving, some of the deals that they couldn't get sold in their internal network, and now they're just offering it to the market. And that way you can start getting an idea of what things are priced for, what assumptions they're making. I mean, in those OEMs, even though it's mostly a selling document, they're kind of highlighting the best of the property. And then once you start looking at the real numbers, you start to see there's a huge difference in the rose color pitch deck that they put in there, because that's all the offering memorandum really is. At the end of the day, it's a sales brochure, right? But it's on you to do the due diligence, do the proper underwriting, to figure out what's what and what's not. And then actually when you get the property under contract, then you're going to try to validate and confirm your assumptions in your underwriting, or you're going to make adjustments based on what you're seeing after you get it under contract and you start getting all the data points. You get thorough inspections of the property, of the physical property, so forth and so on. So, but nonetheless, there's great information in there, a lot about the market. Maybe in instances that have transactions that occur, because they'll keep that data to themselves as well. So it just starts to give you reference points and data points, and along your journey to help you further along, because that's what it is. I mean, at the end of the day, it's about who has the data, the most amount of data, accurate data, the most information to make the best decisions, right? I guess all in all, like I said, when it comes to assumptions, getting that down, getting down a method of how you evaluate properties. There's tons and tons and tons of videos from people that have been doing it for years, from analysts that get paid, hundreds of thousands of dollars a year to do this for the large private equity funds that are buying, hundreds of millions of dollars of properties and buying stuff, if not monthly, weekly, right? And then just creating your own particular process, slightly modified off of that, and then going from there. So, until next time, before I go, don't forget to like, share, subscribe, join the Facebook group. Let's always continue the conversation. Leave a comment, share information, request information. And certain topics we want to talk about, let's talk about it. Again, I don't know everything. I'll do research on stuff that if somebody has a certain topic, I'll do some due diligence and research on it. That's what I spend my time, some of my time doing on certain days, of just researching and just absorbing the knowledge, looking for trends and opportunities, and how does that work as far as acquiring properties, acquiring the type of properties I want to acquire. So, on top of the doing the daily transactions in retail, office, and industrial on the leasing side. So, if there's a certain topic, leave a comment in below, share, subscribe, ask other people to join that that may be interested. Like I said, this is a platform I think where we can all get connected with pretty much the same ideals of things that we want to achieve, and working together, finding partners, raising money, so forth and so on. And if there's anything else I can be of service to, definitely let me know. So leave that in the comments. But yeah, we're going to continue this thing going, man. So I appreciate you guys' time today on this Wednesday. Like I said, just want to talk here briefly about some underwriting, because I've been doing some here lately. And I thought it'd be a good topic to talk about just briefly. Again, if I can be of any help, feel free to reach out. So join the group. Let's continue the conversation. And happy investing. Until next time. Deuce.
These my dollars make it hurt.